Hello, listeners. We are very excited to announce our new weekly podcast for the accounting world, specifically for the ones who love auditing as much as we do, or who want to educate themselves on this field of accounting. Let me introduce you to the Audit Report, where we will give you weekly news on everything audit related. My name is Lindsay.
I'm Allie.
And I'm Cooper.
Before we dive into anything specific, shouldn't we inform the listeners on general background information about what an audit exactly is, who cares about it, and why it's important?
Yes, that is a great idea. For this very first episode, the topic is specifically, what is the current value of audit? Who cares whether the financial statements are audited or not? Lindsay, do you want to start us off by explaining to the listeners what exactly the audit process is?
Yes, I would love to. For a general definition, auditing is when the financial information of a company is evaluated by a third party. The purpose is to provide a reasonable level of assurance to stakeholders that what is reported on the financial statements are fair and truthful.
When does this process take place?
Great question. This process takes place throughout the year, especially at interim points such as end of quarters, semi-annual, annual, etc. This audit process usually happens after management has prepared the statements. The auditor then will come in and get a feel for the company environment and check the statements to see if they are free from any material errors, omissions, or if any bad practices seem to have occurred.
What financial statements are exactly looked at during the audit?
Another great question. I should have mentioned that sooner. The statements that are typically checked are the income statements, balance sheets, and statement of cash flows.
Thank you for all that great information, Lindsay. I also wanted to iterate that there are things that auditors are actually prohibited from doing for their clients. Specifically, Sarbanes-Oxley prohibits professional service firms from providing any of the following services to an audit client. 1. Bookkeeping and related services. 2. Design or implementation of financial information systems. 3. Appraisal or valuation services. 4. Actuarial services. 5. Internal audit sourcing. 6. Management or human resource services. 7. Investment or broker deal services. And then 8. Legal and expert services, which are unrelated to the audit.
Yes, that is a great point to add, Allie.
This audit process seems like it would cost companies a lot of money. Is that true?
Yes, there are definitely more costs with the audit process, both with independent and internal auditing. In fact, there are controversies among shareholders on whether there's a real benefit to the audit when looking at the costs of it. However, in my opinion, if shareholders truly understand the importance of auditing, their viewpoint might change. I know I can think of many different reasons on why auditing is important and valuable. Can you guys?
Yes, I certainly can think of many examples.
I agree. There are a ton of different ways auditing is valuable and is worth the cost. For example, a company may have policies in place that if a certain profit goal is met, then the management and directors get bonuses. So, let's say that this company has reported that they have reached these profit goals, meaning the bonuses have been given out. However, this company also wants a loan from the bank, and the overall industry the company is in has not been doing that well. Therefore, it is important to make sure the reported profits aren't fake or exaggerated. This is where an independent auditor comes in. They're unbiased and follow strict rules, checking the company's financials, reviewing sensitive information, and making sure everything adds up. The auditor then issues a report, giving the bank and shareholders confidence that the numbers are accurate.
That is a great theoretical example, Lindsay. Can we all dive deeper into the specifics on what makes auditing important for our listeners today?
Of course, that's a great idea.
Awesome. Well, the first thought that comes to my mind about what makes auditing important is how it establishes trust. Shareholders and stakeholders only receive information from the company itself. Therefore, they have to solely rely on the company if they are being truthful about how the business is doing.
You're correct. So realistically, what would stop a company from lying if there is no one to check their work?
Precisely. Therefore, it is important to have an independent auditor who is like a messenger between company and management and shareholders. With not having a stake in the company, the auditors are able to give unbiased decision on whether they think the financial statements are properly and fairly reported. Therefore, this enables more trust for the users of the financial statements.
I agree 100%. This trust also relates to what came up in my head right away, which was auditing being important because of the transparency it brings. Organizations that openly let third parties look at their information often shows they are more open and responsible. Therefore, people are more likely to invest in companies that are open with all of their information, rather than the ones who have a lot of secrecy.
You know, auditing isn't just important for shareholders, but also the company as a whole. All companies have to follow laws of a financial reporting framework. This would be either IFRS or GAAP for U.S. companies. Professional auditing is used to make sure these rules are followed. The standards can be changed, and sometimes management simply just misses on the up-to-date procedures. So auditors are helpful with catching any of those mistakes since they are required to stay up to date on the reporting framework.
You're exactly right. The company is also able to give even more benefit from an auditor's expertise. Auditors give accountants a fresh, new perspective about best practices for reporting. Is there anything else that you think that we're missing on what makes auditing important, Lindsay?
Yes, the auditing process is extremely important for companies to build confidence in their own systems and processes. Management is benefited by setting up their own internal controls and systems to make sure they have smooth flows of operations, as well as finding any potential corrupt employees. An auditor looks at the processes in the company and compares them to the industry to see if they're working well. Once the auditors say the company's internal controls are good, management can feel secure knowing their system is strong.
Well, I think that is a nice list that gives the listeners a great picture on why auditing is so valuable to have. I think the next part we should dive into is all of the rules and regulations auditors must follow. Cooper, do you want to start us off?
Of course. Well, like the scenario Lindsay previously described, it is important for the public to understand that there are strict rules and standards auditors must follow. Knowing the auditors have strict guidelines helps the public trust and value the audit process more. The standards that are followed are called Generally Accepted Auditing Standards, GAS for short. The three principles auditors have to follow are within the responsibilities, performance, and reporting. Lindsay, can you explain to the listeners the responsibilities of auditors?
Auditors first must have the competence and capabilities to perform the audit, meaning they have the proper expertise in the industry the company is in. They also need to be independent in fact and appearance to the company, meaning that they have no biases or stake in the company, as well as the public perceiving them to be that way. Finally, auditors have the responsibility to have professional skepticism, which is the appropriate questioning and assessment of evidence, as well as professional judgment, which is the application of training, knowledge, and experience in making informed decisions of the audit. Allie, what should our listeners know about auditors' performance standards?
Well, the main goal of auditing is providing reasonable assurance that financial statements are reported fairly. To meet this performance standard, they must have proper planning and supervision of the audit, materiality throughout the entire process, proper risk assessment, and sufficient and appropriate audit evidence. Last but not least, there are reporting standards. Would you like to talk about those, Cooper?
With reporting standards, auditors must express an opinion or indicate that an opinion cannot be expressed on an entity's financial statements. This assessment of financial statements is required to be against the financial reporting framework.
Next, I think it would be a good time to dive into the different types of auditing. Specifically, we will be discussing the two main types of audits, which include internal and external audits. Allie, would you like to kick this off with explaining what an internal audit is?
Yes, I can absolutely do that. First, an internal audit evaluates a company's internal controls, including its corporate governance and accounting processes. Not only that, but they also help make sure everything is in compliance with laws and regulations. Additionally, they help maintain accuracy as well as timely data collection and financial reporting. One other important element is they provide management with the necessary assistance and tools in order to maintain operational efficiency through solving problems and correcting lapses before discovery within an external audit.
Also, internal audits offer risk management and evaluates the effectiveness of many different areas of the company. Furthermore, there are some critical different types of internal audits which we will share with you all. Lindsay, could you please kick us off with the first couple of examples?
For sure. Our first example we are going to look at is a financial internal audit. This is classified when public companies are required to perform certain levels of external financial auditing, where a completely independent third party provides an opinion on the company's financial records. Another commonly seen example is operational. In this instance, this is most likely to occur when key personnel leave or when new management takes over an entity.
I would also like to jump off your ideas and share two other examples. Next, another type of internal audit is compliance. With this example, this is when a company may be required to adhere to local laws, compliance needs, government regulations, external policies, or other restrictions. Finally, the aspect of an environmental audit can be viewed as companies continually becoming more environmentally conscious, which some take the steps of reviewing the business's impact on the planet. Cooper, would you like to finish our internal audit discussion by addressing some final key points of this process?
I would love to. Furthermore, internal audits are conducted through planning, auditing, reporting, and monitoring steps. They enhance the efficiency of operations, motivate employees to adhere to the company policy, and allow management to explore specific areas of its operations. This is something that may take place on a daily, weekly, monthly, or annual basis. Moving forward, I think that is all we have for today for internal audits. Lindsay, can you kick us off by sharing the next main type of audit?
Absolutely. Now we are going to transition over a bit to the opposite side of things, which is an external audit. External audits are defined as audits that are performed by outside parties, which helps remove bias when reviewing the state of a company's financials. Typically, an external auditor will look for and review items such as reporting accuracy, system configurations, access controls, transaction processing, data integrity, and compliance.
Great insight, Lindsay. Thank you. While there is no exact way on which audit is better, it is important to be able to perform both types of audits to avoid major biases as well as get insight from multiple sources to avoid major violations to compliance regulations. With that being said, there are some big benefits that external auditors provide through their examinations, which Cooper will dive into.
First, taking a look, one major advantage to external audits that always stands out is the idea that they are impartial, thus meaning they have no previous relationship with the coders or providers at the organization. Feeding off that same idea that may provide validation to situations discovered during internal audits. Next, following the external auditors are on your side, their goal is to look for potential opportunities to keep you compliant. Finally, external auditors are focused solely on the audit. Internal auditors may have other job duties that could be a hindrance.
Great explanations, you guys. Thank you for sharing. Next, we got a question from one of our listeners that fits in perfectly with today's topic that I think is important to address. The question we need to address is, who cares about the financial statements? Wow, what an awesome question. Specifically, some vital people who should care about financial statements include lenders, investors, and other external stakeholders. While an individual might not think they have an important role to the company, even a very small shareholder plays an essential role in the meaning of numbers on the financial statements.
Again, great question. I would also like to add some more important information. First and foremost, I would like to go back to some of the simple basics of financial statements. To begin, financial statements provide an overview of a corporation's financial health at a particular point in time. Overall insight is given into its performance, operations, cash flow, and conditions. Specifically, shareholders need financial statements in order to make informed decisions about their equity investments. Next, Cooper will finish up with some other critical pieces on the crucialness of financial statements.
Thank you, Ellie. Some other pertinent information to share is that banks may require one to provide audited financial statements before they will approve any loans. Next, sureties usually require them for bonding purposes. Before we move on to the next piece of information, I would like to clarify what exactly a surety bond is. A surety bond is defined as a promise by one party to take responsibility for another party's debts if the borrower defaults. Moving forward, some governmental agencies also require companies to provide audited statements to bid on contracts. Last but not least, a financial statement can provide information about a company's revenues, expenses, profitability, debt load, as well as the ability to meet its short-term and long-term financial obligations.
Well said, Cooper. Going off a similar subject, another question that needs to be answered is, what happens to the users if statements are not properly audited? Starting right off the bat, inaccurate financial statements can lead to far-reaching consequences for the particular company as well as for investors and other stakeholders. Some other alarming things that can occur include wasted time and resources, bad decisions, and cash flow problems. In particular, I wanted to comment on the cash flow problems. In this scenario, it can cause the company to short on cash when paying bills or payroll. With that underreporting cash flow can mean missing opportunities for investments, income, or interest.
To wrap up this section of today's talk, a few other instances that may occur if statements are improperly audited include fines and penalties. Fines will generally come from the IRS and local authorities. One other major aspect is reputational damage and loss of credibility. More specifically, in this case, with errors in the process, no matter if they are unintentional, consequences will still arise and overall leads to an unsettling look. Finally, lenders may consider that applicants with financial reporting errors are riskier and charge them higher interest rates or may not even give them money.
I think we have time for just a few more key points. What's the next topic you have for us, Lindsay?
Let's discuss the economic value of audits and how the economy has evolved in response to changes in auditing practices. The role of audits has significantly impacted financial markets and business operations. A great historical example of this is the 1929 stock market crash and the Great Depression.
That's right. The 1929 crash revealed serious flaws in the financial reporting, as many companies were not held accountable for how they presented their financial statements. This lack of oversight led to widespread financial instability. In response, the U.S. government established the Securities and Exchange Commission, the SEC, in 1934, making audits mandatory for publicly traded companies.
These events highlight how audits promote investor confidence and market stability. Without independent auditors verifying financial reports, the company can suffer due to misleading or fraudulent reporting. Over time, audits have continued to evolve with changing economic conditions, regulatory updates, and new technology.
Now, fast forward to today, audits remain a crucial part of financial oversight. According to a 2024 report by the U.S. Government Accountability Office, financial statement audits provide essential benefits such as improved financial management, detection of misstatements, and increased efficiency in governmental financial operations.
While audits provide value, they also come at a cost. The cost of an audit depends on several factors, including the size of the company, industry regulations, and complexity of financial transactions.
Exactly. According to Forbes, the cost of a financial audit starts at around $10,000 for smaller companies and can go up significantly for larger corporations. But the real question is, what do businesses get in return for this investment?
Well, there are quite a few benefits. Audits enhance investor and lender confidence, detect fraud, improve inventory management, and provide better data for decision making. A well-conducted audit can also help businesses avoid regulatory fines and penalties that could arise from financial misstatements.
On the flip side, audits can also disrupt operations. If issues are uncovered, leading to additional costs and time-consuming corrections. However, the long-term benefits often outweigh the short-term costs.
Now, let's look at how auditing has changed over time and the impact of key financial scandals. A well-known example is the Enron and WorldCom scandals in the early 2000s, which completely reshaped auditing regulations.
Yes, these scandals led to the creation of the Sarbanes-Oxley Act, SOX for short, which occurred in 2002. This introduced stricter auditing requirements and corporate accountability standards. Before SOX, companies had more freedom in financial reporting, but after its enactment, audits became much more rigorous, significantly reducing financial fraud cases.
Another game changer is the digital revolution in auditing. With AI-driven analytics and automated audit tools, audits are now more efficient, reducing human errors and improving fraud detection capabilities.
Absolutely. As audits continue to evolve, their role in maintaining financial integrity remains just as crucial as it was in 1934, if not more so today.
Unfortunately, I think we're out of time for today. To briefly wrap up what we talked about the definition of auditing, the importance of auditing, the rules and regulations auditors have to follow. Then we dove into the main types of audits, who cares about the financial statements, and what happens if financial statements are not properly audited. Finally, we talked about the economic value of auditing, the cost of auditing, and then concluded with some statistics.
Thank you all for tuning in, and we look forward to next week's episode.